Minimum bonus we have talked about 8.33%, maximum bonus 20%, and the principle of set on and set off. Actually, the system in the Act is very automatic. Suppose you have more allocable surplus, 20% you can pay, and then the remaining you can transfer to the as set on. As and when there is a deficiency, we can take from the set on. It is something like this. Suppose you are a shopkeeper and in about 8 months the income is, your normal expenditure is 30,000, and for 8 months the income is only 20,000, and for the remaining 4 months, maybe Raksha Bandhan, maybe Diwali, maybe Dashera, the income is 70,000 rupees per month. Normal expenditure of the family is 30,000 rupees. So common sense is, in order to maintain the 30,000 every month, the months in which you are making the profit of 70,000, save something for the period where the 30,000 income is not there, so that every month you can maintain the standard. So therefore, in this case, let me give an example and then we'll deal with the principle of set on and set off. Suppose the allocable surplus, and every year, every accounting year you have to pay the minimum bonus whether you have the allocable surplus or not. And if the allocable surplus is more, then you will not pay more than 20%. And if more and more allocable surplus is there, then another 20% you can set on. So therefore, these are the three things. Number one, minimum bonus 8.33%, maximum bonus 20%, character of the salary and wages, and another 20%. If you have allocable surplus much more, another 20% you can set on, and this set on can be used for 4 years. So what is the set on? When the allocable surplus exceeds 20% of the maximum bonus, then another 20% or another 20% of the salary and wages you can transfer as set on, and this can be used for 4 years. Similarly, if the allocable surplus is falling short of the minimum bonus, then it can be set off and it can be used for 4 years. I just give an example to illustrate the allocable surplus and the set on and set off. Suppose I take a very simple example. In an organization, the annual salary in an accounting year is 1200 rupees. Suppose annual salary in an accounting year is 1200 rupees. Minimum bonus comes to 100 rupees. The salary is how much salary? 1200 rupees in an organization, in the total organization, applicable to the employees on a salary not exceeding 10,000 rupees. So their accounting year, the salary is 1200 rupees. Then in an accounting year, how much minimum bonus comes of the salary? 8.33%. So 100 rupees is the minimum bonus. What is the maximum bonus? 240 is the maximum bonus. Okay, now see the operation. In the first year, suppose the allocable surplus is only 100 rupees. As I said, the bonus is payable out of the allocable surplus and payable in proportion of the salary. So in the first year, you have the allocable surplus, assuming 100 rupees. You pay 100 rupees. There is no set on and set off. 100 rupees, allocable surplus, 100 rupees is the bonus, 8.33% pay. Second year, assuming you have 600 rupees allocable surplus, then you can pay the maximum bonus 240. So 600 rupees is the allocable surplus, then pay 240 as the maximum bonus, 20% pay. Then another 20%, because 240 we have paid and yet we have 360 rupees in the allocable surplus. So after paying 20% maximum bonus, another 20% you can set on. So you have set on 240. So in the second year, second allocable surplus 600 rupees. Third column, maximum bonus 240. And another 20% we have set on 240. So second year 600 allocable surplus, maximum bonus 240, and another 20% we have set on. Third year, suppose we have the allocable surplus of 500 rupees. So you pay 240 maximum bonus, another 240 you transfer as set on. So for second year you have set on 240, in the third year you have set on 20% 240. So set on will not be more than 20%. In the fourth year, assuming you have 100 rupees, okay, you have 100 rupees as the allocable surplus. So you have the set on 240 and 240. So in the fourth year you have 100 rupees, pay maximum bonus 240. 140 you have paid more. तो ये 140 जो सेकेंड ईयर है जिसमें 240 आपने सेट ऑन किया था, वहां से 100 रुपीज आप ले लीजिएगा. तो फोर्थ ईयर में क्या हो गया कि फॉर सेकेंड ईयर द सेट ऑन रिमेन्स 140. नहीं, आई एम सॉरी, फॉर द फोर्थ ईयर द सेट ऑन रिमेन्स 100 एंड नेक्स्ट फॉर द थर्ड ईयर का जो 240 था वो 240. तो फर्स्ट ईयर 100 rupees no set on. Second year 600 rupees 240. तो सेकेंड ईयर बिकॉज दिस 240 जो आपने सेट ऑन किया सेकेंड ईयर में ये 4 साल तक काम आएगा. थर्ड ईयर यू हैव 500 रुपीज 240. तो सेट ऑन कितना हो गया सेकेंड ईयर का 240 एंड थर्ड ईयर का 240. फोर्थ ईयर में यू हैव ओनली 100 रुपीज एज द एलोकेबल सरप्लस. लेकिन चूंकि सेकेंड ईयर का और थर्ड ईयर का 240 आपके पास है तो आप मैक्सिमम बोनस दे सकते हैं. 240 आप फोर्थ ईयर में पे कर दिए. 140 की जो कमी हुई है 140 जो कमी हुई है वो सेकेंड ईयर में से 240 में से 140 ले लीजिएगा 100 रुपीज और थर्ड ईयर का 240 बच गया. फिफ्थ ईयर में देयर इज ए नो एलोकेबल सरप्लस, nil एलोकेबल सरप्लस, बट अगेन यू कैन पे 240. वाई? क्योंकि सेकेंड ईयर का 100 रुपीज बच गया है और थर्ड ईयर का 240 बच गया है. करेक्ट. तो वहां से आप ले सकते हैं 240 आप पे कर सकते हैं. करेक्ट. इन द फिफ्थ ईयर यू कैन पे 240. तो कितना आपने लिया? नील है 240 लिया. तो सेकेंड ईयर का जो बच गया था 100 रुपीज वहां से ले लीजिएगा और 240 में से 240 में से 140 ले लीजिएगा. अब आपके पास बच गया थर्ड ईयर का 100 रुपीज. करेक्ट. तो इसी तरह मान लीजिए अगली बार भी आपका नील है तो आप 100 रुपीज पे कर दिए क्योंकि 100 रुपीज सेट ऑन है. तो अब मैं एक एग्जांपल देता हूं. आई जस्ट गिव एन एग्जांपल टू इलस्ट्रेट दिस. सपोज वी हैव टेकन 1 2 3 4 5 6 years we have taken. Now how many columns are there? 1 year. Second column allocable surplus. Third is bonus payable. Fourth is set on. So these are the 4 columns. One is the year, second is allocable surplus, third is the bonus payable, and the fourth is set on. So first year, how much is the allocable surplus? 100 rupees. And we have the salary of 1200 rupees in an accounting year. So 8.33 per 100, pay 100, set on nil. Second year, your allocable surplus is 600 rupees. Second year, 600 rupees. Can we pay 240, maximum 20%? Yes, pay. And not more than 20% you can set on. Another 20% you set on. So in the first column, second year. In the third column, 600 rupees allocable surplus. Maximum bonus, third column, 240 and set on 240. This is the second year. Third year, we have 500 rupees allocable surplus. Maximum bonus, 240. Another 20%, 240. 20% of the salary. Set on. Correct. So third year, 4 column. Third year, second 500 rupees, 240 and 240. Coming to fourth year. Fourth year, our allocable surplus is 100 rupees. But we have the set on For the second year 240, for the third year 240. So we have to use it. So for the fourth year, even if the allocable surplus is 100 rupees, we can still manage to pay 240 maximum. So pay in the fourth year 240. There is a shortage of 140. So we have 240, second or third year. So we'll take 140 from the second year. First come, first serve. From the second year, we'll take 140. So 100 will pay bonus 240. And in the fourth column, since we have taken 140, so in the fourth column for the second year, जो हमारा 240 था सेट ऑन, वो अब रह गया है 100. तो 100 रह गया, फिर 240. करेक्ट. फिफ्थ ईयर, सपोज देयर इज नो एलोकेबल सरप्लस, नील, हम फिर भी 240 पे कर सकते हैं. 240 पे कर दीजिएगा. सेकेंड ईयर का 100 रुपीज बच गया, वो ले लीजिएगा. 140 और बच गया, 140, वो थर्ड ईयर में से ले लीजिएगा. करेक्ट. तो सेकेंड ईयर का 100 रुपीज ले लिया, 140 यहां से ले लिया, तो थर्ड ईयर का 140 सेट ऑन बच गया. करेक्ट. सो दिस इज, तो मैंने 5 साल का लिया. सो फर्स्ट ईयर द एलोकेबल सरप्लस 100 रुपीज, सेकेंड ईयर 600 रुपीज, थर्ड ईयर 500 रुपीज, फोर्थ ईयर 100 रुपीज, एंड फिफ्थ ईयर नेट. सो 100, 600, 500, 100 and net. This is allocable surplus. And this is the bonus. 100 rupees, 240, 240, and still 240. Yes, we have managed to pay. And then, this is set on. So therefore, the principle is that we can, if the allocable surplus is more than 20%, then another 20% we can set on. If the allocable surplus is falling short of the minimum bonus which we have to pay, then the, deficiency can be set off. Correct. So this is an example of the minimum bonus and the maximum bonus and the principle of set on. Correct. So I'm sure it is clear. To 100 rupees, 600 rupees, 500 rupees. Correct. And then 100 rupees and nil. Allocable surplus. 100, 6, 500, 100 and nil. And then bonus 100 rupees, 240, 240, 240. And इधर कितना बच गया? Yes, ये set on. पहले साल कुछ नहीं बचा, 100 में 100 दे दिया, दूसरे साल 240 दिया, तो 240 बच गया. This all. Correct. Now friends, I've already indicated how to calculate the available surplus. So this is all that I've already indicated, that these are the directions that to be made. Under section 5 or 6, depreciation, development rebate, development allowance, direct tax, and the directions permissible under schedule 3. So these are the directions which are to be made. So this is schedule 3. Now we have already indicated that the available surplus is to be calculated. Gross profit में certain directions are to be made. One is the depreciation, another is the development rebate, correct? And the development rebate we have to deduct, and then direct tax and directions under schedule 3. So then out of the gross profit, these directions are to be made. Then we come to know of the available surplus. And then the allocable surplus 67 or 60%. Now friends, so we have talked about the set on, set off, we have talked about the minimum bonus and the maximum bonus. Now there are 3 things. Section 17, Section 18 and Section 19. Can the employer pay the puja bonus or the customary bonus? Or can he pay the part of the bonus before the bonus becomes payable? The whole idea is either you can name by way of puja bonus or the customary bonus, because in West Bengal, puja is very big festival. So therefore if the employer has, and these are all the part payment of the bonus before the bonus becomes payable. You may give any name to it. Either you can give the name to the puja bonus or the customary bonus or a part of the bonus before the bonus becomes payable. So section 17 says, if the employer has paid the puja bonus or the customary bonus or the part of the bonus before the bonus has become payable, then the employer is entitled to deduct the wages, the bonus paid in an accounting year. He is entitled to deduct, and then he will pay the bonus, remaining bonus. Let me take an example. Now let us take an example. Suppose in an accounting year you are entitled for 100 rupees as the bonus. You have been paid in an accounting year by way of customary bonus or the puja bonus or the advance payment of bonus 50 rupees. Then the employer will deduct out of 100 this 50 already paid to you, and then the employer will pay the balance 50 rupees. The thing that is to be remembered is that the advance payment of bonus which is made can only be deducted from the current year's accounting year. The year in which you have paid the advance, only from that accounting year the deduction can be made. It cannot be carried over. This all. So therefore this is the adjustment of the puja or the customary bonus or the advance payment. This is section 17. Section 17 we have talked about, if you make the part payment of the bonus before the bonus becomes payable or the puja bonus, from that accounting year you can deduct. It cannot be carried over from the accounting year. Now coming to section 18. 18 we briefly talked about before. Suppose the employee is guilty of misconduct, and as a result of the misconduct, the loss is caused to the employer. Then it is lawful for the employer to deduct the losses. He can deduct the losses from the bonus payable in an accounting year, and he can pay the balance. So therefore the employee is guilty of misconduct. Number one, as a result of this misconduct, there is a loss to the employer. Employer can deduct this amount from the bonus payable only from that accounting year where the misconduct has happened. Take for example, suppose the bonus is payable in an accounting year 100 rupees. Employee is guilty of misconduct and causing loss of 50 rupees. So from that accounting year's 100 rupees, you can deduct 50 rupees. And then the employee is liable to pay the balance to the employee. This is section 18. Now remember one more point. I will just remind you. There are the two circumstances. One is if you have been dismissed because of fraud, and that we talked about in section 9. If the employee has been, there are the two circumstances. If the employee is guilty of fraud, is dismissed. Why he has been dismissed? Because he was guilty of fraud. He was guilty of righteous and violent behavior on the premises of the employer, or he was guilty of sabotage or the misappropriation or the theft. And he has been dismissed because of this. Then the bonus will not be payable. Remember the word. Dismissed for these reasons, no bonus. But here in this case, section 18, this is 9. Section 18, guilty of misconduct. Loss is caused, you can deduct. Correct. To the extent of the loss, only in an accounting year where the loss has happened. So this is the difference between 9 and 10, 9 and 18. Now the third is time limit. So I have taken the first and the third point before. Now coming to the time limit, within what time the bonus is payable? The bonus is payable within 8 months of the close of the financial year, in normal case. So in the normal case, the bonus is payable within 8 months of the close of the financial year. But if the government so desires, if the employer applies, and then the government can extend this 8 months up to 2 years. So therefore the bonus is payable within what time? Within 8 months of the close of the financial year. Can the government extend this 8 months? Yes. When? On an application by the employer, government can extend this 8 months. Up to what? Up to 2 years. Let me just take an example to illustrate this. Suppose your accounting year is closing on 31st March 2010. In normal course, the bonus is payable within 8 months. So on 30th November or before 30th November 2010, the bonus is payable. But suppose the government extend the period. So this 8 months can be extended up to 2 years. So then if the government has extended up to 2 years, then instead of 30th November 2010, you can pay the bonus up to 31st March 2012. So this 8 months can be extended up to 2 years. Second point, this is one normal case. An extension can be given. Second case is, if suppose there is a dispute before the authority, dispute about something which is before the authority, then the bonus is payable what? Then the bonus is payable within 1 month. 1 month of what? 1 month from the date when the award becomes enforceable or settlement comes in operation. So therefore section 17, advance payment of bonus, third column, can we make the deduction? Section 18, then the in between, what is the time limit for payment of bonus? Yes. Now what is the establishment in the public sector? Before we pass on to the bonus in the public sector, let us see what do you mean by the public sector? Establishment in the public sector. If the establishment, number one, is owned, managed or controlled, A, by the government company as defined in section 617 of the Companies Act. So therefore the establishment is owned, managed or controlled, A, by the government company, or B, by the corporation, where 40% of the paid up capital is being held singly or together, one, by the government or by the Reserve Bank of India or by the corporation owned by the government or the Reserve Bank of India, then such an establishment is in the public sector. So what is the establishment in the public sector? Owned, managed and controlled. By whom? 1 and 2. Either by the government company or by the corporation. Which corporation? Which is owned. Corporation where 40% of the paid up capital is being held by the government or the Reserve Bank of India, or by the corporation owned by the government or the Reserve Bank of India. So this is the establishment in the public sector. Now what is the bonus in the public sector? Now I have already said the establishment in the public sector. When it is owned, managed or controlled, A, by the government company, or B, by the corporation where 40% of the capital is being held by the government or the Reserve Bank of India, or the establishment owned by the government or the Reserve Bank of India. So this is the establishment of the public sector. Remember the word. If you have the establishment in the public sector, no bonus is payable. No bonus is payable. This is one part. But the second part is, if 20%, the establishment in the public sector sell the goods or provide the services in competition of the private sector. So one thing is that the establishment in the public sector has not to pay the bonus. But then the question is can it pay the bonus? Yes. Which case? The case is, if suppose the establishment in the public sector sell the goods or provide the services in competition with the private sector, and the income from the sale of the services in competition with the private sector is 20% of the gross income, then the establishment in the public sector has to pay the bonus in accordance with the provisions of this act. So normally it is not to pay the bonus. Is it still liable to pay the bonus? I am again repeating. If it sells the goods and provide the services which are in competition with the private sector, and the income from this sale of the services in competition is 20% of the gross income, then the establishment of the public sector will pay the bonus according to the law. Take an example. Suppose the gross income of this organization is 100 rupees in an accounting year, and this establishment is selling 20 rupees goods or services in competition with the private sector, then the bonus is payable by this organization in the public sector. This one. Now friends, there is a productivity linked bonus. Actually what happens? So far this act is concerned, we provide the payment of bonus linked on the profitability. Because as I said, you pay the bonus out of the allocable surplus. Allocable surplus is a part of the available surplus, and available surplus is profit after deductions. So in nutshell we can say that the annual bonus is based on the profitability. So we pay the bonus out of the profitability in proportion of the salary in an accounting year. So three things. We pay the bonus out of the profitability in proportion of the salary to the employees in an accounting year. Now we have given one more freedom, that we can pay, instead of paying on the base of the profitability, we can pay the bonus linked with productivity. So therefore section 31A says the employees have made a contract or the settlement with the employer, and under this settlement or the agreement, there is a provision that the employer will pay the annual bonus linked with production and the productivity. Instead of paying on the base of the profit, the employer will pay on the base of the productivity and the production. So you can pay. Then two things are there. Number one, if suppose by this agreement or the settlement, employees give up their right to receive the minimum bonus, then such a settlement or the agreement is void. And number two, their maximum bonus will not exceed 20% of the salary and wages. So three things are there. Can the employee be paid the bonus based on the productivity? Yes. If the employees make the settlement or the agreement with the employees, then the employer is liable to pay the annual bonus based on the productivity and the production. But if the employees say what they say, that we give up our right to receive the minimum bonus, 8.33% of the salary or wages, then such an agreement is void. And then how much they can be paid? Their bonus will not exceed 20% of the salary and wages. Let me just take an example. Suppose the employees have made an agreement with the employer to pay the bonus based on the productivity. And in the agreement they say that we give our right to receive 8.33% minimum bonus. But as when yes, you have productivity, more and more productivity, pay up to 30% of the bonus. So our answer will be that such an agreement is void. Because number one, they give up their right to receive the minimum bonus. It's void. And secondly, maximum bonus cannot exceed 20% of the salary or wages out of the productivity. Now friends, what about the new establishment? Section 16 provides about the payment of bonus by the new establishment. Section 16 provides that the goods are sold or the services are provided. Then from the day when the goods are sold and the services are provided, in the first 5 years, first year, second year, third year and fourth year and fifth year, in the first 5 years, the company will pay or the establishment will pay the bonus if the company makes a profit. And the bonus will be payable as per the provisions of this act. But there will be no set off and set off in the first 5 years. So therefore, 4 things are there. In the case of the new establishment, what are these 4 things? The day when you sell the goods and provide the services. From that day, in the first 5 years. Number 2, in the first 5 years, will you pay the bonus? No. Bonus will be payable only when the establishment makes a profit in the first 5 years. Number 3, payment of bonus will be, however, done as per the provisions of this Act. And number 4, no set-on and set-off will apply. Take for example, suppose the annual salary in an accounting year is 1200 rupees. So therefore the minimum bonus comes to 100 rupees. In the first year, you have no profit. In the second year, you have no profit. In the third year, because you will pay the bonus as per the provisions of the Act, and the minimum bonus is 8.33% and maximum is 20%. So in the third year, your allocable surplus is 100 rupees. Pay 100 rupees, 8.33%. If your allocable surplus in the fourth year is 50 rupees, no payment of bonus. Despite the fact that you have not the allocable surplus, actually the profit. So in the first year, no profit. In the second year, no profit. In the third year, you have the profit of 100 rupees. Pay the minimum bonus as per the law, 8.3, 100 rupees you pay. Fourth year, you have the profit of 50 rupees, no payment. Because you will pay the bonus out of the profit, but you will pay the bonus as per the law. Law says 8.33% and 20%. So 50 rupees and 8.33% comes to 100, don't pay in the fourth year. Comes to fifth year. Suppose the fifth year, you have the profit of 500 rupees. Then pay the maximum bonus, 240, because the bonus is to be paid, not the total as per the law. So pay 20 rupees, 20%, 240 you pay. Coming to the sixth year. Now the law says, from the sixth year, the set-on and set-off will be available from the fifth and sixth year. So suppose in the fifth year, you have the profit of 500 rupees. You have paid the bonus 240, maximum 20% you can pay. Coming to sixth year. Sixth year, you have a profit, allocable surplus 100 rupees. 240 is remaining of the fifth year. So sixth year, you can pay 240. 500 rupees, there was the profit of the fifth year, you pay 240, 240 was, fifth year and sixth year, set-on and set-off will start. So in the first 5 years, no set-on, set-off, but for the sixth year, the set-on and set-off will start in between fifth and sixth year. So when you come to the sixth year, the set-on and set-off will start from the fifth year. You have the profit of 500 rupees, you pay 240 because you have to pay the bonus as per the law. But pay not out of the allocable surplus, out of the profit. So you have the profit of 500, you pay 240. And 240 you have paid. Now come to the sixth year. When you come to the sixth year, then again for the sixth year, fifth year becomes important. Because the law says for the sixth year, the set-on and set-off fifth and sixth year will apply. So now when you come to the sixth year, then the set-on of fifth year for sixth year will be applicable. So in the fifth year, you have the set-on of 240. Coming to the sixth year. In the sixth year, you have the allocable surplus of 100 rupees. Since you have in the fifth year 240, so you can take 140 and you can pay 240 maximum bonus. Coming to the seventh year. When you come to the seventh year, then the set-on and set-off of fifth, sixth and seventh year will become applicable. In the seventh year, you again have 200 rupees. So you can pay the bonus in the seventh year 240 because you can take 40 rupees from the fifth or sixth year if available. Come to the seventh year, come to the 8th year, then automatic rules will apply. So now friends, let me once again repeat. So number one, if you are in a new establishment, so from which date new establishment? Then the year when you sold the goods and you provided the services. From that date, in the first 5 years, 1, 2, 3, 4 and 5, you will pay the bonus only out of profit. Number one. Number two, allocable and set on and set off will not apply. And third, you will pay the bonus out of profit as per the law, 8.33% up to 20%. So first 5 years, this will happen. Coming to 6th year, let me first tell you the law. In the 6th year, the set on and set off of 5th and 6th year will apply. In the 7th year, set on and set off 5th, 6th and 7th year will apply. In the 8th year, as usual, 5th, 6th, 7th and 8th. Now let us take an example. In the first year, no profit, no bonus. In the second year, no profit, no bonus. In the third year, and we presume that your total salary in an accounting year is 1,200 rupees. In the third year, you have the profit of 100 rupees. Pay as per the law, 100 rupees you pay the bonus. No set on, no set off. In the fourth year, you have a profit of 240. 240 is the maximum, pay 240. In the fifth year, you have the profit of 500 rupees. Pay 240, maximum bonus. Now coming to 6th year, then the set on and set off of 5th and 6th year will become important. So 5th year, when we come to the 6th year, then we reopen 5th year again. 240 maximum you are paid. For 6th year, you have to set on and set off for 4th year. So now set on, set off 240. Maximum set on to 20%. So 240 you are paid, 240. 500 was their profit, so 240 you have set on. In the 6th year, suppose there is no allocable surplus, assuming. So the 5th year you pay 240. 6th year is over. In the 7th year, 5th, 6th and 7th will apply. Set on of 5th, 6th and 7th will apply. Correct? So in the 5th and 6th year, no set on, set off was left. Because what was available in the 5th year was consumed in the 6th year. In the 5th year, we have the allocables, we have the 20% set on 240. In the 6th year, there was no profit, no allocable surplus, 240 we have paid. In the 7th year, yes, if you have, because set on, set off, 5th, 6th and 7th year. In the 7th year, you have 100 rupees. So there is nothing to set on, set off for 5th and 6th. 7th year, you pay 100 rupees. 8th year, then the set on and set off of 4 years will apply. 5th, 6th, 7th and 8th. Now friend, then further, what is the new establishment? If there is a change of management, if there is a change of location, if there is a change of name, if there is a change of ownership, then this is not taken as the establishment of a new establishment. So this is all about, my friends, section 16. Now friends, section 21, recovery of the bonus. Suppose the bonus is due under the agreement of the settlement. So bonus is due under the agreement of the settlement. Then the application can be made to the government. Who will make the application? The employee, or the employee can authorize someone, then he can make the application to the government. If the employee has died, then the application can be made by his heir or representative or assignee. If the government is satisfied that the bonus is due, then the government will pass an order to the collector who will recover the bonus as per the areas of land revenue. So therefore, if the bonus is due to the employer, award, agreement or settlement, application to the government, who will make the application? Either the employee. If the employee has died, then the heir or the representative or the assignee, or the employee can authorize any person, then he can make an application to the government. Government will issue, government if satisfied will issue the certificate and the collector will recover. as the areas of land revenue. And this is how recovery can be made. But this provision, remember, is without prejudice to the recovery in by other means. Meaning thereby कि अगर किसी और तरीके से भी recovery होती है तो ये this provision will not affect that provision adversely. Now friends, suppose there is a dispute between the employees and the employer. What is the nature of the dispute? Dispute is about the payment of the bonus or about the applicability of the act to the establishment in the public sector. So there is a dispute about the payment of bonus. There is a dispute about the applicability of the act to the establishment in the public sector. Then this is taken as the industrial dispute under the Industrial Dispute Act 1947. When the dispute is there, then this dispute is referred to the authority under the Industrial Dispute Act. The dispute is referred to the authority. Actually, what happens? It's only a matter of arithmetical calculation. Because the bonus is payable on the basis of the profit. Profit is a part of the accounts. Profit is a calculation and all that. So dispute is pending before the authority and referred to the authority because there is a dispute. Authority is asking for the information from the employer. Kindly give us the information, P&L account and the balance sheet and the statement of the particulars. Provide us the information. Employer provides the information. Then one thing, if suppose you are a company, then your accounts are audited by the qualified chartered accountant. If you are the corporation, then your accounts are audited by the CAG, Comptroller and Auditor General of India. Then the authority before whom the accounts are placed, giving the information, the statement, the authority can presume that since they are audited by the qualified people, the accounts are correct. And therefore the company and the corporation are not to prove the accuracy of the accounts by affidavit. They are presumed to be correct. But the matter does not stop here. This is one part of it. Second part, if the authority feels that probably they are not correct, then the authority before whom the process dispute is pending can take the steps to find out the accuracy. Third, support to the dispute, the trade union is a party to the dispute. The trade union says to the authority, we want the clarification of certain matters. We want the clarification of certain matters. And the authority is convinced that clarification is needed to be given. Then the authority can ask the employer of the company and the corporation kindly provide the clarification. So therefore the heading of all these section 22, 23 and 25, they are mixed together. And the net result, number one, in case of the corporation, company accounts are audited. There is a dispute. Dispute is pending before the authority. Authority is asking for the accounts. Authority takes these accounts presumed to be correct. Why? Because they are audited. Correct. But that is not the end of the matter. The authority, what the authority feels, probably they are not correct. He can take his steps. Next, trade union, which is a party to the dispute, asking for some clarification. Then or if the trade union is not a party to the dispute, the employees are the party. And the employees request the authority, if we want the clarification of certain items, then the authority, if necessary, deems fit, ask the employer of the corporation, the company, to provide the clarification. So this is when the establishment is a company and the corporation. Take another case. In the other case, you are the sole proprietor having 20 people in your employment, or you are the partnership firm. There the auditing is not compulsory. So therefore the authority before whom the dispute is pending can ask these organizations to kindly get your accounts audited in the prescribed manner. And then if they are audited, then the authorities can take those accounts as correct. And if they are not audited, despite his command to them, not audited, then the authority himself get them audited. So this is how he can presume these accounts to be correct. This is all. Section 21 delete kar diye. Now friends, now we pass on almost to the concluding part of it. The government may appoint as many people as they think proper to the inspectors. And when the government appoint them, then the government can identify their area of jurisdiction. Why the inspectors are appointed by the government? Naturally, for the purpose of this act. Naturally, to see that the provisions of this act are complied with and the appointment is made. Then the question, what are the functions of the inspector? There are the 5 functions, broadly speaking, of the inspector. To begin with, number 1 function, he can require the employer to give the information as he may desire, because the inspector is to see that the provisions of this act are complied with by the organization. They are paying the interim, minimum bonus, maximum bonus, set on, set off, and etc., and within the specified time. So there the first function is that the inspector may require the information from the employer as he deems fit. Number 2, inspector may enter the premises with the help of the assistance of the other people. He may enter the premises and he may require the production of the documents and the registers. Which register he may require the production? Which has the record about the number of the employees employed and the payment of the salary. So second, he can enter the premises and require the production of documents, and which document, not all the documents which contain the information about the number of the employees employed and the wages paid. Number 3, he can examine the employer, he can examine the agent of the employer, he can examine the servant of the employer, he can examine the person who is in charge of the premises, he can examine any person whom he deems fit about the employee, he can examine. Number 4, he can take the copies and extracts from the records and the registers. And number 5, he can perform other functions. So these are the 5 functions. 1, require information. Number 2, enter. Number 3, examine. Number 4, extract, and other functions as may prescribed. Public servant, he is the public servant. And therefore all the safeguards which are available to the public servant, they are available to him. Secondly, if he asks anyone to do this, he is bound to do. He is bound to do. This is all. Now friends, we pass on to the penalty. How much is the penalty? If the organization where this act applies contravenes the law, rules, or does not follow the direction, then there is an imprisonment up to 6 months, or the fine up to 1,000 rupees, or it can be both. So this is the amount of the penalty. Now friends, the central government may grant the exemption. Exemption from what? An exemption when? Central government by notification, the official gazette may grant the exemption to any establishment or class of establishment. From which provision? From all the provisions of this act or any of the provisions of this act. Can you grant the exemption for indefinitely or a specified period. The government may grant the exemption. So many things are given. Government may grant the exemption by way of notification, the official gazette. Whom? Establishment or class of establishment. Exemption can be granted from all the provisions or any provision. Exemption can be granted for the specified period. Exemption can be granted subject to conditions. Then ultimately, when can the exemption be granted? Before the exemption is granted by the government will have the regard to the financial position of the organization and other relevant factors. And if the government feels that it is in the public interest, then the government may grant the exemption. So exemption having regard to financial position, other relevant factors in the public interest, you can grant the exemption. Now friends, before I proceed, let me just make a little comparison. In section 32 as well, this act does not apply to certain organizations, to certain employees that we have talked about in section 32. There also, the government may exempt any financial institution. Government may say that this act will not apply to the financial institution. So under section 32, there is a list of the organization where this act does not apply, and the government can add any other financial institution that this act will not apply to it. Or under section 36, the government may exempt. What is the difference between these two? One difference is, in section 32, you grant the exemption for all the time to come, that this act will not apply to it. Under section 36, you may grant the exemption for a specified period of time. Under section 32, you can grant the exemption to financial institutions. Under section 36, you can grant exemption to any establishment. Third, you grant the exemption that this act will not apply. There the language is that this act will not apply under section 32. Here you say that this establishment is exempted. Number 4, there you grant that this act will not apply under section 32, having regard to financial position, character of the activities, nature of the activities, concession granted, and other relevant factors. Here you grant, if it is public interest, financial position, other relevant factors. So this is the difference between these two, section 32 and 36. Now friends, the last is, suppose there is an establishment, it has a branch, it has a department, it has an undertaking. So this undertaking and the branch and the department, will it be taken as the part of the establishment or not? So the question before us is, establishment is a branch, has a department, has the undertaking. Will all these branch, department, undertaking, will it be taken as the part of the establishment? May be taken, may not be taken. Normally they are taken as a part of the establishment. But in these two cases, they will not be taken as a part of the establishment. What are these two cases? Number 1, if we prepare the separate balance sheet for the undertaking, for the branch or for the undertaking. And number 2, never before they have been treated as a separate establishment. I'm sorry. So therefore, in these two circumstances, these will not be taken as a part of the establishment. But on the other hand, they will be taken as separate establishment. What are those two circumstances? If we prepare the separate balance sheet for the undertaking, for the branch, for the department, and never before they have been taken as a part of the establishment, then this will be taken as separate establishment, which means we will calculate the allocable surplus for this, and for this, and accordingly will apply the Payment of Bonus Act 1965. Now friends, thank you very much. You have given a patient hearing to me, and I am really grateful to you and I am sure that this will help you. Thank you so much. Thank you, sir. Now friends, this is how we finish with the Payment of Bonus Act. Always a question on it. let me just summarize. Two things let me summarize. We have talked about the minimum bonus, we have talked about the maximum bonus, we have talked about the set on and set off. We have talked about that the bonus, if the loss is caused to the employer can deduct the bonus. We have talked about if you have been dismissed, the bonus will not be payable. The employer can pay the advance bonus, the employer can pay within 8 months, which can be extended up to 2 years. In case of the dispute pending, the employer has to pay within 1 month when the award becomes enforceable. Then we talked about the definition of the employee and the employer and the salary and the wages. And then accounting here we talked about. Then we talked about what is available surplus and what is allocable surplus. And you have to pay the bonus out of the available allocable surplus. So from what you have to pay out of the allocable surplus, to whom you have to pay? To the employee. In what proportion you have to pay? In proportion of the salary or the wages. How much you have to pay minimum, how much you have to pay 20%. How you can set on in there is a loss or more profit, then there is a principle of set on and set off. When the bonus will not be paid when dismissed, when it will be deducted when financial loss is caused. Can we pay the advance bonus? Can we, within what time we have to pay? These are all the things that we have talked about, and how the 30 days will be calculated that we talked about. Yes, so this all, and the new establishment, what will happen if the new establishment is there, that we talked about, correct? And then we talked about the bonus is not paid, how you can recover. Then we talked about the inspector, then we talked about the penalty, then we talked about the, linked bonus, bonus based on productivity and the production, correct? And where this act applies and where this act does not apply. So therefore in section 2, we talked about the definition. Section 6, yes, 4 and 6, available surplus, how to calculate available surplus. And in this connection, we talked about Schedule 3. Then we talked about section 8, 30 days you have worked. Section 9, dismissed, then the bonus will not be payable. Section 10, minimum bonus. Section 11, maximum bonus. Section 13, 14 we talked about how to calculate 30 working days. Section 15 we talked about set on and set off. Section 16, new establishment. Section 17, advance payment or puja bonus. Section 18, financial loss cost as a result of misconduct. Section 19, within what time we have to pay. Section 20, establishment of public sector. Section 21, recovery. Section 23, 25, etc. Audited account presumed to be correct when the dispute is pending. Section 27, inspector. Section 28, penalty. And Section 31A, production based on productivity. And Section 36, exemption. So this all we talked about. एक small